stock markets have gotten stuck. And the question now is whether they can resume upward momentum, or at least pretend to try, or whether we might actually come off in the other direction. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we are going to look at what the macro calendar looks like in the week ahead and what might be driving things from there. But of course, before we get started with trying to figure out where things are going, we do need to understand where they've been and how they got there, if we can figure out next steps, because of course it's the reaction function that we need some clarity on. So what we'll do here is take a look at what the markets did last week and why it seems they did it, and move on from there to try to figure out what next steps could be. Here's how the markets then performed last week. Notice the S&P 500, the bellwether for Wall Street here, chalking up a meager gain of 0.2%. That's the fourth consecutive week that momentum has slowed. And the situation for the high-flying NASDAQ looking even more circumspect. It puts in essentially a goose egg for last week. That's a little bit of a rounding. It rose 0.03% on the current NQ futures contract, but that's hardly anything to cheer about. And of course, we can see where that is most certainly, almost certainly coming from. Yields surging. The 10-year up 5.7%. The 2-year up even more, 10.2%. So the yield curve actually flattening a bit, but not because people have walked back expectations for higher rates downwind, rather because more of the adjustment has come at the front end with Fed rate cut expectations cooling. Crude oil surging, but that seems to be happening again for its own reasons. The hotting up of tensions in the Middle East, probably not something to be missed there. Could be an explanation for a pickup in crude oil demand, but we'll get to that in just a moment. Gold managing to hold up, and perhaps that's telling that story of geopolitical worries, because in an environment where yields are surging like this, an asset like gold, which yields nothing, really should be doing much worse. The US dollar higher, though, thanks to the yields adjustment. Euro down 1.8%, the yen down 4.6%, and Bitcoin getting washed as another asset that yields nothing, and might have been compared to gold in that sense, but clearly gold is holding up better, which, of course, for yet another week now raises questions about the argument that Bitcoin or crypto in general is some kind of a digital gold haven asset, which the evidence seems to suggest is not at all the case. So looking at the price action here, higher dollar, higher yield, circumspect stocks, it seems to follow that the markets looked at the shifting of Fed rate cut expectations and got spooked. Now, we can very clearly see that here in the orange is the sum of rate cut expectations as they're reflected in Fed funds futures for this year and next. In the gray is this year, in the orange is next. And the sum here, as we can see, down to 129 basis points, or about 1.3% between now and the end of next year. Now, we can see that as we've had this adjustment materialize, this, of course, is the Fed's own rate cut right here. the 50 basis point cut that they announced on September the 18th. We can see that the markets had one pop of strength thereafter and have since stalled, and that's because the direction of adjustment in this outlook, as we've talked about here for about a week or two now, has been into a less dovish setting. In fact, if we consider where the markets were the day of the Fed and then even just a week ago, what we find is about a week ago, the markets were looking at 165 basis points in cuts between now, or then at least, last week, the beginning of October, and the end of 2025. On Fed Day, the outlook through the end of 2025 looked more like 220 basis points in cuts. Whereas what we're looking at now is, of course, quite a ways away from even last week's outlook. And of course, if we look at the way it compares with the Fed's own prognostications, we can see that the Fed was looking for 100 basis points in cuts this year. Recall this is, of course, done on the 18th. So at that point, the starting line for rates is 5.3%. Factor in the Fed's 50 basis point cut, then consider they expect rates to come down to 4.4, so about 100 basis points lower than 5.33, which is the median of the Fed's target range before the cuts. And then in 2025, from this starting point, another 100 basis points. In other words, the Fed is saying that after the 50 basis points cut in September, there is another 150 basis points in cuts left. 50 basis points here in November and December, ostensibly at 25 basis points apiece, and another 100 basis points next year. Well, now the markets are at a setting that is essentially 21 basis points, or almost a full rate cut, less dovish than the Fed's own thinking. So what is going on here? Well, we saw already in the wake of the Fed's policy announcement that the markets thought it would be inflationary, or at least that the Fed would have less scope to cut downwind than was anticipated before the announcement. And we can see that here. At the top is the 20, 10, and 5-year break-even rates. Those are the bond market's expectations for inflation. You get those by taking the difference between nominal and real rates, and then you get that inflation adjustment that takes you there from nominal to real. And you can see that those inflation expectations have been rising since the beginning of September. In fact, you can also see that the curve has been steepening until, of course, it started to flatten for all the wrong reasons. Again, not as the long end has cooled, but as front end interest rates have gone up. And gold has moved higher. That, of course, around speculation that inflation would be hotter. So the reflation dynamics were very much already afoot when the Fed delivered its announcement and essentially endorsed them. More of the same followed after. Here's the second half of September here. And over the past week, that has only been aided by U.S. economic data that has increasingly improved relative to expectations. So what we find here is that actually going into September and ahead of the Fed's announcement, U.S. economic data starts to improve relative to forecasts. And by the time we get into September and into the most recent figures here over the past week and a half or so, we find that not only is U.S. economic data improving relative to forecasts, now it's actually moved to start having a tendency to beat expectations. When this surprise index from Citigroup goes over zero, and it's been under zero since basically the beginning of May, when it goes over zero, it's telling us that US economic data is now tending to surprise higher, not just surprise lower by a narrower margin, not just come in soft but closer to expectations. No, now it's tending to beat. And of course, we saw that in spades with last week's news flow. The two really standout figures here, the outcomes from the service sector ISM survey, as well as the U.S. jobs report, of course. We'll look at the ISM survey here first. We can see here that when looking at this data, we've had a sharply strong rise in service sector activity growth. That's this spike right here. It is, in fact, giving us the strongest pace of expansion for the U.S. service sector in 19 months. And then, of course, the prices component in that same story is a very important uptick here. That's the highest since April as far as the pace of underlying service sector inflation. New orders surging, the highest since the beginning of 2023. So sharp pickup in economic activity, sharp pickup in new orders, and all of the inflationary or reflationary evidence to go with it. Needless to say, that bids up yields and encourages speculation that perhaps we're going to get less easing from the Fed than met the eye when they met in September. For a similar story from U.S. employment data, 254,000 jobs added in September. That's much, much faster than the expectations. The markets were looking for a meager 140 or 145,000, depending on which expectations you looked at. Moreover, the prior numbers were revised significantly higher. We had the numbers for August revised and the numbers for July revised to higher settings. So U.S. jobs growth showing impressive strength. The unemployment rate unexpectedly ticking down to 4.1%. That's the lowest that we've seen the lowest since June. Moreover, as if to really make the point as emphatic as it possibly could be made, wage growth accelerates unexpectedly, and we end up jumping to a 4-month high of 4% here. That's the highest, or the fastest rather, since May. So all of this, not surprisingly, is painting us a story of a U.S. economy that is showing itself stronger than expected. And that, of course, not surprisingly, is eating into how many rate cuts the Fed can reasonably do while still keeping its eyes on inflation. We had a speech from Fed Chair Jerome Powell at the beginning of last week that nicely sets up the first bit of economic news flow this week, and that's minutes from September's fateful FOMC meeting. Now, this is, of course, inherently backward-looking because the data we've just seen, this most recent run of strong numbers, all happens in the future relative to September's meeting. But what we clearly have is Powell speaking Monday last week, again, before any of this data, even just by a few days, and saying we're not in the kind of hurry that the markets think we are. We see the risks as two-sided, not one-sided. We've not gone from a singular focus on inflation to now a singular focus on employment. We still want to get to 2% inflation. We are in no hurry to cut. That, ostensibly, is the most clear picture of the kind of rhetoric we are likely to get from these FOMC minutes. Because, of course, while the meeting is some weeks back now, the actual minutes document is not exactly a word-by-word transcription. Rather, it's an editorialized document. And if the Fed, of course, is aware that the markets are going to look at it for guidance. So if the message that it wants to set is, we're cutting, but we're not cutting with abandon. We don't think we've missed the boat on growth. We don't think there is a recessionary emergency or anything of the sort. That would, of course, encourage what we've just seen, which is to say a more circumspect view from markets and a stingier, for lack of a better word, view on how many rate cuts we're actually likely to see. Now, beyond that comes the most standout piece of macro data risk for the week, and that is the U.S. CPI report. Now, here we're expected to see continued disinflation at the headline, down to 2.3%. That would be the slowest inflation that we've seen since the beginning of 2021, February of 2021 to be specific. And that, of course, is a tremendous victory for Fed policy officials, but it may not be as sweet of a number considering the core reading where Fed officials actually have agency to act. That's expected to hold unchanged at 3.2% for the third consecutive month. One of the reasons that there was the big decline in headline inflation in August from 2.9 to 2.5 was a drop in energy. In fact, 28 basis points worth of contribution there, or 0.28 percentage points contribution on the negative side to inflation in August. You can see this little yellow bar right here on the negative side. Food, of course, still slightly positive, and goods inflation overall negative, but energy had been something of a slight uplift, and we can see here in August that turned the other way. More of the same likely on the menu this time, accounting for what's going on at the headline. But the key here is, of course, where the Fed can actually have agency, and that's where most inflation remains stuck, the service sector. And here we can see things are stalling once again. We, of course, already know what this movie looks like because we've seen similar stalling here coming out of late 2023 and into the beginning of this year. That's where the Fed was sitting around going, yeah, maybe we're not in a position to cut at mid-year as we thought. Yeah, we're forecasting 3 cuts in December and March, but by May we're disappointed, and by June we've officially lowered our forecasts from 3 cuts to 1. They've, of course, had a massive rethink on that score, but that too was in the wake of just 3 months of core inflation idling. If that's the kind of message that we're going to come away with here, especially when we consider how the pricing component in the ISM service sector, that sector, of course, close to 80% of the U.S. economy, if we see how that's been behaving here, then the risk might well be to the upside. But even if we basically land in line with expectations, scope for aggressive easing is going to look suspect. And then, rounding out the week, there is the University of Michigan Consumer Confidence Survey. Here, we're expected to see a third consecutive month of improving sentiment right here. And we would be hard pressed to imagine that things would be particularly dire in an environment where we've already seen from the jobs report that we've had faster hiring, we have had a lower unemployment rate, and faster wage growth, which, given inflation at the headline falling, let's call it to 2.5%, has only increased the purchasing power of consumers and their catch up to the post-COVID cost of living increase, because, of course, the wider the spread between wage growth and price growth in favor of wages, the faster consumers catch up, the faster their cost of living adjustment moves in their favor. So it seems unlikely that sentiment would have done poorly, even if there is a consideration in this survey for the 1 year inflation expectation index rising. The expectation is that it's going to go down to 2.6% from 2.7%. Even if the markets were to look at the most recent rise in crude oil, say over the past week, and that were to work its way into this forecast, which, of course, given when the survey was conducted, seems unlikely. But even if that were the case, seems like we're probably not going to get a very negative view on sentiment, or at least are unlikely to. And if that is so, then still more evidence arrives saying that fewer Fed rate cuts might be in the offing and yields might need to go higher. All of which might suggest that as we move forward and these numbers get smaller and smaller, this stalling here might start to turn into an outright sell-off, whereas gains for the US dollar might continue. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things are likely to go there from. I'm back with Chris Fridays for Futures Power Hour, on For the Price of Truth with Victor Jones on Wednesdays, back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow.